In 2024, the S&P 500 handed every investor in America a 25% return. Free money, basically, just for showing up. But the average person who had money in the market that year didn't get 25%. They got 16.5%. Same market, same year, same opportunity. An 8-point gap vanished, and almost nobody noticed it happening to them. That gap has a name. Financial researchers call it the behavior gap, and it might be the most expensive tax you've never heard of because no government collects it. You collect it from yourself, one bad decision at a time. Marcus is 29, works in logistics outside Columbus, Ohio, and makes about $61,000 a year. In January 2020, he opened a brokerage account with $8,000 he'd been sitting on since college. He didn't pick individual stocks. He didn't try to time anything. He just put it in a broad market fund and left it alone, the way his uncle told him to. For 2 months, nothing happened. Then, in March 2020, his account dropped 30% in about 4 weeks. Marcus watched the number fall every single day, and on a Tuesday night, he sold everything. 6 weeks later, the market had recovered almost all of it. Marcus was sitting in cash, watching a recovery he wasn't part of. Here's what should bother you about that story. Marcus didn't do anything financially illiterate. He didn't fall for a scam. He didn't buy a meme stock. He made the single most common mistake in investing, the one that even smart, careful people make, and it cost him more than any bad stock pick ever could. So the real question isn't, how do you pick good investments? It's this: why do people who own good investments still end up with bad results? Here's the part that sounds impossible until you see the math. Over the 20 years ending in 2024, the S&P 500 returned an average of about 9.7% a year. The average investor holding funds tied to that same market earned about 8.7%. 1 percentage point. That's it. Doesn't sound like much. But run that gap over real money and real time, and it turns into this. $1 million invested in the index becomes roughly $6.3 million after 20 years. That same $1 million run through the average investor's actual behavior becomes about $5.3 million. $1 million gone. Not to fees, not to taxes, not to a crash, to timing. This isn't a fringe theory. It's measured every year by independent research firms that track actual dollars flowing in and out of mutual funds, not what returns were available, but what returns people actually captured. And the finding repeats year after year, going back to the 1980s. Investors, as a group, buy after prices rise and sell after prices fall. They chase performance that's already happened, and they flee losses that have already occurred. 2024 was actually one of the worst recent years for this gap. Investors missed roughly 8.5 percentage points of the market's return, largely because money kept leaving stock funds every single quarter, even as prices climbed higher. In 2025, that gap narrowed to under 1 percentage point. One of the tightest years on record, which tells you something important. This isn't fixed. It's not a tax rate written into law. It's a behavior. And behavior can change. Picture 2 people standing at a bus stop. The bus is the market. It's going to your destination no matter what, some days smoother than others. Person 1 gets on once and stays seated for the whole ride, even through the bumpy roads. Person 2 keeps hopping off every time the bus hits a pothole and gets back on a few stops later after walking part of the way in the rain. They arrive at the same destination eventually. But person 2 paid for a full ticket and only rode part of the route. That's the behavior gap in one image. The market isn't the problem. Getting on and off is. In the 1980s, this gap barely mattered to most households because most households weren't in the market at all. Pensions did the investing for you, and nobody watched a number update in real time. By the 1990s, 401k plans put individuals in the driver's seat for the first time, and the gap started showing up in the data. In the 2000s, two major crashes, the dot-com collapse and the 2008 financial crisis, taught an entire generation that watching your balance too closely leads to panic selling near the bottom. By the 2000s, smartphones put your portfolio in your pocket, checkable at 2 a.m. And today, in 2026, the tools that were supposed to make investing easier, instant balances, push notifications, real-time charts, are often the exact things making the behavior gap worse. The friction that used to slow people down before making a bad decision has almost entirely disappeared